Hello and welcome to the Week 8 tutorial of Financial Analysis for Investments. This week we are covering applications of the financial statement analysis, tools and techniques. There are a number of reasons for an analyst to examine a company's past financial performance. For example, cross-sectional analysis of financial performance facilitates the understanding of the comparability of companies for a market-based valuation. Market-based valuation is based on pricing multiples. Pricing multiples are ratios of a stock market price to some measure of value per share. For example, the price to earning ratio uses the earning per share, while the price to cash flow ratio uses the cash flow per share. Although the valuation method may be used independently of an analysis of a company's past financial performance, such an analysis provides an understanding of why there are differences between or among the company's price earning or other valuation multiples. Cross-sectional and trend analysis can provide information for evaluating the quality and performance of a company's management. Cross-sectional analysis involves analyzing a company against its competitor or close peers, while trend analysis involves evaluating the past performance of a company and identifying any trends. Evaluation of past performance does not only cover what, but it also covers why. That is, it does not only addresses what has happened, that is how the company has performed, but it also answers why the company has performed better or worse. Specifically, it identifies the causes behind the performance and how the performance reflects the company's strategy. Evaluative judgments assess whether the performance is better or worse than a relevant benchmark, such as the company's own historical performance, a competitor's performance, or market expectations. Some key analytical questions include the following. How and why have corporate measures of profitability, efficiency, liquidity, and solvency changed over periods being analyzed? How do the level and trend in a company's profitability, efficiency, liquidity, and solvency compare with the corresponding results of other companies in the same industry? What factors explain any differences? What aspects of performance are critical for a company to successfully compete in its industry, and how did the company perform relative to those critical performance aspects? What are the company's business model and strategy, and how did they influence the company's performance as reflected in, for example, its sales growth, efficiency, and profitability? Here we have Apple as an example, and we have its sales, gross profit, and net income plotted in this chart. Apple is a company that has evolved and adopted over time. In its 1994 prospectus filed with the US Securities and Exchange Commission, Apple identified itself as one of the world's leading personal computer technology companies. At that time, most of its revenue was generated by computer sales. In the prospectus, however, Apple stated the company's strategy is to expand its market share in the personal computing industry while developing and expanding into new related businesses such as personal interactive electronics and Apple Business Systems. Over time, products other than computers became significant generators of revenue and profit. In June 2007, Apple entered the mobile phone market with the launch of the original iPhone, followed in June 2008 by the second generation iPhone 3G, a handheld device combining the features of a mobile phone, an iPod, and an internet connection device. The company launched the iTunes App Store, which allowed users to download third-party applications onto their iPhones. Apple is an example of a successful differentiation strategy. Typically, products that are differentiated either through recognizable brand names, proprietary technology, unique styling, or some combination of these features can be sold at a higher price than commodity products. Sales of differentiated products at premium prices would generally be reflected in the gross profit margin. Such sales would have a higher gross profit margin keeping other things constant. Based on Apple's financial data as shown here, the company appears to have successfully implemented a differentiation strategy with gross profit margin increasing from 33% to 40% of sales in the 4 years period. Operating profit margins are also affected by premium pricing as a result of successful differentiation strategy. Expenditures on advertising and research are required to support differentiation. However, the effect of premium pricing on operating profit margin is often weaker than the effect on gross profit margins. Now here we see that Apple's liquidity has improved continuously over the 4 years period. This is attributed due to organic growth as the company has done no acquisition and has also retained all its cash because it did not pay any dividends till 2012. Apple's current ratio in 2009 is nearly 2.7 times, while its current ratio in 2010 is nearly 2. At the same time, its cash and marketable securities as a percentage of total assets are on average 70% over the 2 years period. In general, some of the considerations that a company makes in managing its liquidity include maintaining enough cash and other liquid assets to ensure that it can meet near-term operating expenditures and unexpected needs, avoiding excessive amounts of cash because the return on cash asset is almost always less than the company's cost of capital to finance its assets, and accumulating cash that will be used for acquisitions, which is sometimes referred to as war chest. On 19th March 2012, Apple announced plans to initiate a dividend and share repurchase program commencing later in the year. From the chart here, we can see how Apple's revenue has evolved from different segments in line with its strategy from year 2007 to 2010. Apple's primary source of revenue for the year 2007 was sales of computers, that is, over 10 billion of its revenue was coming from the sales of Mac computers, representing 42% of the total net sales. Its secondary source of revenue was iPods. Apple's product mix has changed substantially since 2007. For an analyst examining Apple relative to its competitors, the relevant comparable companies clearly changed from 2007 to 2010. Recently, the company may be more appropriately compared not only with other computer manufacturers but also with mobile phone manufacturers and companies developing competing software and systems for mobile internet devices. Forecasting future net income and cash flows, including the earning per share, is one important responsibility of the financial analyst. Often, a forecast begins with a revenue forecast using variety of inputs including trend relative to prior years. There are broadly two approaches to forecasting sales: the top-down approach and the bottom-up approach. In the top-down approach, industry sales are projected on the basis of their historical relationship with some macroeconomic indicator such as the growth in real gross domestic product. Regression analysis can be used to establish the parameters of such relationships. The company level market share is projected on the basis of historical market share and a forward-looking assessment of the company's competitive position. Then the company's sales are estimated as the projected market share of the company multiplied by the projected total industry sales. This is how it is done in the top-down approach. In the bottom-up approach, for each of a company's major product or segment, volume and price changes are projected. Individual companies' projection can then be aggregated to produce total industry level projections if needed. So in the bottom-up approach, we start with projecting the volume and price changes for the company's major products or segments and then aggregate them to get the total company sales, and then for all the companies in the industry we can aggregate their sales to get the industry level sales volume. After developing a revenue forecast, that is forecasted sales, the analyst can use ratios expressing the relationship between revenues and various items on the income statement to forecast income. An analyst may use historical common size data as an input to developing expectations about specific expense line items. For example, the cost of goods sold in the next year and then the year after. Similarly, advertising expenses, journal expenses, marketing expenses, taxes, operating income. The gross profit margin could be used to forecast gross profit directly and or to forecast cost of goods sold. We know that gross profit equals sales minus the cost of goods sold. The operating profit margin can then also be used to estimate the operating profitability of the company directly. Using operating profit margin or gross profit margin, in other words, historical information to project future earnings and expenses for a mature company is more reliable. However, the same is not useful for a new or growing company or a company that is operating in volatile business environment. Forecast of the balance sheet can be based on the relationship of the given items with sales from specific forecasts, or it can be based on financial ratios. For example, to forecast the amount of receivable, an analyst can use the days receivable data from previous year's ratio analysis. Similarly, to forecast the amount of inventory, the analyst can use the days inventory data from previous period's ratio analysis. And to forecast the amount of property, plant and equipment, an analyst can use the property, plant and equipment turnover data from past periods ratio analysis or specific forecast for capital expenditure if they are available. The amount of forecast liabilities would typically be a result of cash flow requirements. After projecting cash flow from operations minus cash needed for working capital and fixed capital expenditure, an analyst can determine financing needs. It is then a modeling choice regarding the extent to which incremental financing is obtained from debt or equity. An analyst can use information from historical and targeted leverage ratios in making that choice. As discussed, the amount of forecast liabilities would typically be the result of cash flow requirements that is determined after projecting the cash flow from operations minus the cash needed for working capital and fixed capital expenditure. The level of operating cash, that is an amount of cash needed for day-to-day operations, is usually an input to forecasts. But change in cash is an output. Change in cash can be an interim output because the amount of borrowing is determined by the amount of cash flow before incremental borrowing. As illustrated in the next slide, forecasts typically involve iterations, that is circularity, because the amount of borrowing is a function of the cash flow requirements, which are a function of earnings and taxes, which depend on income net of interest expenses, and interest expense is a function of the amount of borrowing. One of the common solutions to the circularity problem of interest expense and borrowing is to calculate interest expenses based on the borrowings at the beginning of the period. This is a good solution in situations where decisions are not overly sensitive to the exact level of interest payments in each period. However, in situations where decisions are sensitive to the exact level of interest payments and to the amount of cash available to repay different tranches of debt, a model needs to incorporate additional detail on debt levels. Alternatively, the analyst can use the Excel solver function to solve for the problem of circularity between interest expense and amount of borrowing. Now we know that for relatively mature companies operating in non-volatile product markets, historical information on operating profit margins can provide a useful starting point for forecasting their future operating profits, at least over the short forecasting horizons. Historical operating profit margins are typically less reliable for projecting future margins for a new or relatively volatile business or one with significant fixed costs, which can magnify the volatility of operating profit margins. In other words, that has higher business risk. This slide compares Johnson & Johnson against Beidou. Based only on the descriptions provided here, would a forecasting method of applying the average operating profit over the previous several years to a forecast of sales be a reasonable starting point for projecting future operating profit? Because Johnson & Johnson is an established company with diversified operations in relatively stable businesses, the suggested approach to projecting the company's operating profit would arguably be a reasonable starting point. In the case of Beidou, a relatively new company has limited operating history on which to judge stability of margins. The company appears to have been in a period of rapid growth and is in an industry that has been changing rapidly in recent years. This important aspect of the company suggests that the broad approach to projecting operating profit would not be a useful starting point. Let's assume that the 2009 forecast of sales was perfect and therefore equal to the realized sales for the company in 2009 for both Johnson & Johnson and Beidou. We compare the forecast of 2009 operating profit using an average of the previous 4 years operating profit margins with the actual 2009 operating profit reported by the company. In the case of Johnson & Johnson, the actual operating profit margin for 2009 is 25.2%, which is quite close to the average for the last 4 years of 25%. This is in line with what we concluded on the previous slide, that for a mature company like Johnson & Johnson, we can rely on the past information to project future profit margins. In the case of Beidou, the actual operating profit margin in 2009 is 36.4%, which is significantly higher than the average of the last 4 years of 27.1%. Again, this is in line with what we concluded on the previous slide, that companies such as Beidou will not be able to predict their operating profit margin based on their previous information of operating performance.